6A was really well done with an average of 75%. And what we're asked to do is explain how the trend in the graph has contributed to the cash shortage problem that the business is experiencing. So what you need to remember is, well, what do debtors turnover and creditors turnover measure? So if you're confused with that and still having trouble with what those ratios mean, go back to the facts of the case video where we explain them in detail. But fundamentally, what we want to remember is that this business, all its sales and purchases are made on credit. There's no cash coming in from cash sales. There's no cash going out for stock purchases. All sales are on credit and all stock purchases are on credit. So it's really important that we do a good job in managing debtors and creditors. So what do these ratios tell us? Let's simplify it and say in 2011, on average, we were collecting debtors in 34 days, and on average, we were paying creditors back in 36 days. Let's contrast that to 2015, where we are now taking 43 days on average to collect amounts owing from debtors, but we're actually paying creditors back much faster. We're paying them back in 26 days. So what does all this information tell us? Well, basically, we are now debtors are paying us 9 days later, which is not good. Now, we are paying our creditors 10 days earlier, which is actually, could be a good trend, could be a bad trend. We could have happy creditors and be getting discounts. But we're not asked to comment on that here. We're just asked to explain, how do these two ratios explain the cash shortage? And fundamentally, it comes down to this. In 2011, we were collecting amounts from debtors in 34 days and paying creditors in 36 days. We're actually 2 days ahead. You want to pay creditors back for the stock you bought from the cash you got from selling it, which would be cash from debtors. So in this case, we were getting that cash from debtors in 34 days and then using it to pay for the stock that we'd sold. The problem in 2015 is it's the opposite. We're now not getting that money from selling stock for 43 days, but we're paying for it in 26 days. We're effectively 17 days behind. We're paying our creditors back for the stock, but not getting the money from selling that stock for another 17 days. So how are we paying them? We must be either borrowing money or selling non-current assets, neither of which is a good option. So let's formulate an answer. There is a cash shortage in 2015 because, let's keep it simple, the creditors' turnover decreased and we are now paying them back every 26 days, but the debtors' turnover increased and debtors are taking 17 days to pay their accounts after 43 days. So we've got a discrepancy of 17 days there between when we get the money from selling stock from debtors versus 26 days of when we're paying for it. 1 mark was given for explaining the creditors' turnover, and 1 mark was given for the debtors' turnover and relating that back to the creditors' turnover trend. The average marks for the exam are very well answered. 65% of the state were able to formulate 2 answers as to how the cash shortage was explained with the figures we were given. The average was 1.5 or 75%, which, as we saw, was one of the higher averages for the paper.